There we go. Now we're recording in the right place. How's everybody doing today? Everybody dug themselves out from the snow. How much did you get this weekend? Fatty, how
That's
much
a
did you get this
ton,
weekend?
a ton. We've had so they predicted about 30 centimeters. I think we probably got close to 50.
Yeah.
I've done my walkway to the car about 5 times, only to just give up on it. The plow came by probably for the street about 6 times, and every time they would block me.
Yeah.
Luckily, my service would come in and plow it it's like they kind of timed it with one another, which is perfect. It doesn't happen often.
Oh, no, this was, there was one year when I was living in Northern Ontario and we got 15 feet over the winter. We had to shovel off our roofs.
Wow.
And by the time we shoveled off our roofs, you couldn't see out your windows anymore. It was dark in the house because there was so much snow piled up. This is the most snow that I remember having in quite a few years. Hi, everyone. Glad you can join us today. All right, let's dive right in. I'm excited to have everyone join us. And oh, hello from Gatineau, Ottawa. Andre must be someone in your network, Fatty.
Probably, yeah. I What's the last name?
LaBelle.
Oh, yeah,
Well,
yeah,
we're
yeah.
we're thrilled that everyone can join us today. I want to dive in as soon as we can because I feel like we're going to run out of time before we run out of topics.
I think so, yeah. I think it's going to be very time sensitive. We do want to cover quite significant amount of stuff. But yeah, it's we're definitely going to run out of time for sure.
Okay, wonderful. So we'll just do the quick introduction, the brief overview. Thank you so much to everyone for joining us today for Scaling Businesses and Portfolios with Smart Investments. My guest today is Fady. If you are in the Ottawa area, then you absolutely know that Fady is one of your go-to realtors and has a very unique skill set that we're going to dive into a little bit more today, and that will give you the opportunity to learn a little bit more about why he is so amazing in the commercial space. Here is
I'm
a quick
blushing already.
well, we haven't even reached your bio yet. Um, just a quick disclaimer that we are going to be talking about things from our experience today. We are not lawyers, we are not accountants. At least I didn't see that in your bio, Fatty. I'm assuming you're not a lawyer. So
No, no,
make sure.
not even on a part-time basis. No.
No. I don't think you could pay me enough to be that. So we want to make sure that you know to make sure that you are including members of your power team and seeking advice in any areas where you need to make really solid decisions, especially anything around money and financing. A quick reminder or refresher about how Zoom webinars work. So in the chat, everybody has probably seen that it might have defaulted to hosts and panelists. I keep changing it and it keeps flicking back. Make sure you've changed the check mark to everyone so that everyone here in the webinar today can see can see your comment in the chat. If you do hosts and panelists, then it's only Fady and I who actually see your insightful and witty comments on our on our presentation. And if you have questions that you would like us to cover at the end, please use at the bottom. You can see there's chat, there's raise hand, and then there's Q&A. Please use the Q&A chat because otherwise, if you post questions in the chat itself, then they get lost throughout the course of the webinar. Whereas having the Q&A, either we can hop in and type a response to you to your specific question, or we can hold questions for the end and address everything. So make sure you are utilizing fully the chat and the Q&A tabs. Our agenda here today is I'll do some quick introductions. We'll talk about the big picture, why commercial and business investments actually matter, and some smart ways to build wealth, whether it's commercial investing, buying businesses, and then key considerations before you invest. We're going to try and have a few minutes at the end to answer questions, but I know, Fady, you absolutely are a rock star when it comes to responding to people's questions. So if we run out of time, I'm going to grab a screenshot of the questions and who has asked, and then you can certainly follow up afterwards and share information if we run out of time. But we're going to try our best to get to at least 2 or 3 questions at the end. And then, of course, I'll be doing a quick wrap up. And for anyone who needs to pop out earlier, then just know that you will be sent this recording before the end of the week and you'll have the opportunity to go through it in depth. It will also be posted to my YouTube channel. So, thank you again for joining us today on your lunch hour. I know it's a short week, which means it's an extra busy week. We're really glad that you were able to jump on and learn more about commercial investing. My name is Elizabeth Kelly. I am a real estate coach, an entrepreneur, and investor. And I've been running my own businesses and building my investment portfolio for more than 20 years now. And I love helping people do the same. And I think that's one of the reasons why we are so lucky to have Fady here as well, because Fady is extremely passionate around commercial real estate, buying businesses, buying investment properties, and has a background in economics. And that's right, you are a mortgage agent too, aren't you, Fady?
Not currently. I don't have a license anymore, but that was back in '07, '08. I did that
Oh,
for a
seven.
stint of time. One of the toughest time to be a mortgage broker is for sure. But then also to just piggyback on that, I've also done commercial and enterprise sales software specifically for about 10 years until I got back into real estate about roughly 4.5 years ago or so.
Outstanding. So you've got a wealth of really transferable skills, experience, knowledge that absolutely make you a great person and a great resource for people who want to get into the commercial space. And with that in mind, I think we're going to dive into the first part. Welcome, Fady. Thank you so much for joining us. Let's talk about the big picture and why commercial and business investments are so important right now. Do you want to sort of bring us up to speed on what you've been seeing in the marketplace and in the mind of investors right now?
Yeah, actually, it brings us to our first point is that transition that we've been seeing. I want to say in the last like 3 or 4 years, especially with the pandemic and what we've had with residential tenancy, and obviously the insane amount of requests that had hit the tribunal and the board. A lot of people are seeing the pinch from that, right? Like I'll give you an example. I was just reading the news actually just today, and there was a lady in Barrie, Ontario, that just got awarded. She's a tenant. She got awarded basically to stay in the property. So things like that have been, changing focus for a lot of investors, having them to kind of shift focus and really dive into something that's a little bit more stable, a little bit more easygoing. They don't have to worry about the Tenancy Act anymore. Just to kind of shed some light on that, the reason why a lot of people refer to or go into commercial investment is because there's no Tenancy Act, right? The Ontario Residential Tenancy Act doesn't really exist. It's more of a contract law. Contract law, what it means is that whatever I put in that contract, once I sign that contract, it becomes now the new law of that interaction or that transaction that we're putting together. So, for example, I'll give you a very, very simple example. If I decided as an investor in my lease, I want to put in that, you know what, they can only open from 8 a.m. to 7 p.m. on a Friday. I can make that the law. They're not allowed to open any time after that. And in the event that they do, it's grounds for dismissal. I can actually go and file and kick them out and send them a quick little notice. The other really good one that's been kind of going around is that with the advent of not having the Tenancy Act, a lot of folks in the commercial side, it's really just as simple as that. If you 10 days you don't pay the rent, on day 11 you can be served a notice, and the lock can be changed completely, which puts you as an investor, it puts you at ease because you know for a fact you're going to be making the rent. Nobody, especially when it comes to retail, like I'm definitely the last thing I want to short myself out on if I own a retail shop is that rent, because I know that's my license to print money. That's my way of making money and getting customers in. And if I can't get customers in the door, I'm not making rent. It's simple as that. Might as well just close. So we've been seeing a ton of shift towards that sort of securing your bet, if you will, securing your investment in a way for a lot of those investors by going into commercial versus residential. It really spiked up in the last couple of years. In fact, a lot of my investors that are coming in, especially on the residential side, coming in saying, "Hey, like I'd love to go and dump, my 10, 15 properties in the next couple of years. What's the plan?" And that's when we sit down and just kind of put a plan together of, okay, well, right now condos are not necessarily selling. Maybe we'll hold off on those, but let's start selling off your townhouses. Let's start off selling your multi-units, for example. And we just want to kind of rephrase it properly. Multi-units are still considered residential up to a maximum of 4. The second you hit 5 and above, then it becomes commercial. So there's a distinction there. So with that being
From
said,
a
it's still
financing perspective, right? Whereas
correct.
when we're talking about commercial today, we're talking a little bit more globally. We're talking about business type properties as well. We're not really talking so much about multi-unit apartment buildings.
Yes and no. It is still considered as part of the commercial side, but
Mhm.
it's not necessarily like I wouldn't include it as really heavy commercial. It only becomes, like you said, from a commercial perspective, when the banks are looking at it, evaluating it, they're evaluating more like a commercial property versus residential, right? They're looking at rent rolls, they're looking at expenses, they're looking at your balance sheet at the end of the day to see if it makes sense or not. But from a residential perspective, you're right. They're still considered residential, but they're banking, they're considered commercial.
Yeah. And the whole point of moving into the commercial space that we're talking about today, quite frankly, is moving away from the Residential Tenancy Act, from the Landlord Tenant Board, from being governed by that whole piece of it, and moving into being governed by contract law, where you can, use a lawyer to draft a really solid lease agreement, and those become the terms that your arrangement is governed with whoever your commercial tenant is in whatever space it is that you're renting out.
Absolutely. And I really like the fact that you said use a lawyer. It definitely is a must. Like no matter what you guys hear from us at the end of the day, it is a must to have an accountant on staff, to have a lawyer on staff, because no matter how good we are at writing contracts, it's not going to be the same, especially when it becomes contract and it becomes the law. You really want to have a lawyer taking a sort of fresh look or a last look at it before you end up signing that lease and committing yourself to something, or vice versa if you're the landlord. Because then now it's just you're on the hook for it for the next 5 years. And it could sometimes make or break the business, especially
Yeah,
when it comes to
absolutely.
specific clauses and things like that within the lease agreement.
Yeah. And especially when you're looking at doing something like there's quite a few of us now who are in the boutique hotel, motel type space, making sure that you are working with someone who fully understands what the difference is between short and long-term rentals, making sure that contractually you are meeting all the obligations, that things are structured in such a way. Honestly, there is nothing wrong with doing your best to steer away from the Residential Tenancy Act at this point because it is such a nightmare for people to deal with.
Absolutely. And at the end of the day, there's nothing wrong with being a bit selfish, right? Like it's your investment, your future, your
Mhm.
family's future at the end of the day. Why do you want to kind of limit yourself to something that you might have an issue with? I'm not saying everyone should, veer away or steer away from it. It's, to
Mhm.
each their own. But it's definitely a way to hedge your bets and making sure that you're not necessarily having to worry about later on having a lawsuit or get hit by something major. Like I'll give you an example. Most of us don't even know that if you have a lease agreement, like a normal lease agreement for a residential property, whether it's a townhouse or a condo or what have you, you're actually responsible to do this. No, believe it or not, as a landlord, unless you clearly state that in the contract, and even then they can still fight you on it because it's against the
You
RTA.
actually you actually need a separate contract with compensation provided to have your tenant do
Correct.
snow removal for their own
Correct.
property, and it can't be shared. So with that in mind, we're focusing on cash flow right now. There's a ton of people right now who want to generate cash flow because maybe they want to leave their job, maybe they see some instability in their job or in the economy in the future, and maybe their portfolio still isn't positively cash flowing right now. So part of what we want to do today is really talk about how do you take charge of your financial future utilizing commercial properties and businesses in order to build your cash flow. So where are you seeing the opportunities right now in your experience or in your market?
A lot of the opportunities we've been seeing lately with folks kind of taking their current home and actually looking for that as sort of their bank account to start with. What I mean by that is, you've got a home that you've been sitting on equity in, been there for 15, 20 years. It might be worth it to go to your bank and say, hey, or even mortgage broker. I would recommend the mortgage broker just for the purpose of allowing you multiple different options. And ask the question. It's really just a simple, hey, like I'm taking a look at this and I just want to know what amount of equity do I have to be able to take out from that? It's a good way for you to take that income or that equity out of the home and use it now as a down payment on the next commercial property or what have you to kind of move in. Now, before I kind of like share with you guys what we've been seeing lately as far as the trend, because you can start as low as 400,000 or 500,000 into commercial. Let's dig into first of all the different types of commercials that are out there, just to kind of give you an idea of what the commercial property landscape look like. So there's actually 5 different types when it comes to commercial. We've already talked about the first one, which is still considered commercial, and that's your multifamily 5 and above, any 5 units and above. And then there is multiple classes of that. There's obviously the high rise. There is a small, 16, 17 unit. There's multiple different ways of looking at multi-units or multifamily. The other prominent one we've been seeing, and that's the one I was just referring to, that with the low start of maybe 500,000, that's your office space. So a lot of folks are looking at, for example, a small condo office where you can go in and purchase the unit, and you're literally offloading the whole entire thing between the mortgage payments, the condo fees, all the expenses off to the tenant, and still have a really good sort of return on investment. Another one is retail. Retail is massive, and if anyone tells you retail is going away, they're absolutely mistaken. Retail right now ranges roughly about 83% of everything we purchase is actually still retail shops. 17% is online, and that just goes into the next one, which is industrial. And a lot of those are hosted at a warehouse, at an industrial warehouse, like the likes of Amazon, the likes of Walmart, and such. And then last but not least is hospitality, and that one is massive. And that one, again, you have sort of the short term, like the Airbnbs of the world. You have the sort of like the medium, and this is when you're talking about motels, boutique hotels, that kind of stuff. And then we're obviously talking about the 5-star hotels that are out there, and those are for different types of investors. So the beauty about commercial is that there is something for everyone. It doesn't matter what your budget is. You can always start somewhere. The beauty about it is that you don't have to worry about an RTA. You don't have to worry about a massive cash flow to start. Yes, you might need a small little down payment that, to be able to break even, because it is always based on the cash flow. And banks will always look at it from a cash flow perspective. So let's dig into that a little bit. Before I dig into that, Elizabeth, did you have any questions about any of these asset classes?
I don't have any questions. What I would love to know, though, is how many people here, type in the chat and tell us how many people are already in the commercial space. How many people already have an office, a strip mall, something along those lines? Maybe it's in the industrial space. But I'd love to know how many people are here sort of gathering information before they purchase versus how many people already have investment properties or have commercial properties. We'll give people a few seconds to answer that, but I think that was a great summary, sort of highlighting the different classes.
Yeah, it's always good to kind of understand the lay of the land, right? Like you don't want to get into a place where you have no idea about, what to invest in. And then it's the same goes like when we all first started sort of investing in residential, we wanted to know a little bit more about the RTA. We wanted to know about what our rules and obligations and things like that. With the commercial, it's a little bit more sort of like the wild, wild west when it comes to rules and regulation, because you can typically put it in the contract, whatever that is. However, it still makes a whole lot of sense for you to kind of figure that out first before you go and invest. And that's really a good chance to start first off with the different types of asset classes out there. Now, the one thing for sure, like I do not recommend for anyone to start investing in each one of those classes, because they're all different. And the reason why I'm not recommending it to, go and invest in each one separately, a big thing that goes without saying is like you want to do something, you want to do it really well, do it multiple times, and you get really, really, really good at it once you do it multiple times. So pick something that you're comfortable with. Pick a niche here out of those 5 that you're very, very comfortable with. I would recommend maybe veering away or steering away from the multifamily, just because of the RTA and because of all the different things that come with that as well too, the obligations and the rules and all of that stuff. And then maybe look into retail or look into office or look into the hospitality business. whichever it is that you want to choose, pick that niche and decide to learn more about that particular asset class before you start investing. So the
Yeah.
big thing we always look at, sorry, go ahead.
I was just going to say, to me, commercial, this is one of those areas where your team is absolutely critical. Making sure you have a good lawyer, making sure you have a realtor who really knows the market inside and out. There's a lot of changes, I think, that are going to happen in the Canadian economy in the next few months as we sort of see how the tariffs and everything else play out. So it might be that something like industrial space is set to boom because suddenly we're having to hold more inventory because we're bringing our raw materials in from another country, not the US, but somewhere overseas. So there's a lot of different ways that commercial, when we understand the economy and what's going on, boots on the ground, then we can make predictions about which is going to be the best investment class and will bring us the cash flow that we're looking for.
Amazing. It sounds like you're taking some of my slides out of me here for
I'm
sure.
sorry.
Industrial has been actually picking up in the last little bit because of, again, all of the folks that are in there, like Amazon. You've got the drop shipments, a lot of the drop shipments, for example, that folks that are using Shopify, things like that. They don't necessarily rely on just, the drop shipment, but a lot of them actually rely on warehouses, and warehouses have been sort of that one thing that I like almost every second call that I'm getting on a commercial lease or commercial space, or hey, I'm looking for this kind of call. It's asking for an industrial space. It's asking for a place where they can have their, industrial with a small office in there that they can run their, for example, DHL delivery from or something like that. So those are booming. They're definitely, getting out there. Retail is definitely making a massive comeback. However, with the retail making massive comeback, the majority of the retail that's coming back that we're seeing is around entertainment. And this is because of what's been happening with the economy. Obviously, office is taking a little bit of a hit. It has been taking a little bit of a hit, but it is coming back, and it's coming back in a different format, which we'll explain here in a second. But with retail, what we've been seeing lately is a lot of comeback coming in for a lot of folks that are looking at entertainment specifically, the restaurant kind of thing, or the, for example, like the bowling alley, the anything where there's an experience, right, where it can bring folks along and they're actually experiencing. We've been completely sort of distancing ourselves with the whole COVID-19 and all of that for the last couple of years, that this is becoming more of the new norm, is that we really want to get together back again. We really want to connect. We really want to have that sort of bond between one another. And what better place to do it than a restaurant or a bowling alley or a small little boutique, cinema, or a movie theater of some sort. We've been seeing a ton of those coming back because of all of what we've experienced for the last couple of years. So each one of those is picking up on a really different scale. For office, for example, what we've been seeing quite often is that, I'm sick and tired of being at home. I want to go and rent out small space, but we've been seeing a lot of shared space, or the, where somebody will buy a space and actually would rent it out to multiple different companies. The beauty about that is, although it's contract law, but it's even better than contract law because it's also short term. So you don't necessarily have to worry about somebody that's going to sit there and do a whole ton of renovations and things like that, and then just you have to kind of repeat that cycle every time they leave, but you still have that option to do it. One of the biggest things that we're always looking at when it comes to commercial real estate is a couple of sort of key metrics that you really want to pay attention to when you're making that investment. And it starts off with just the pure and simple one is the net operating income. If you guys are familiar with that, it can be easily calculated. It's you take out the whole gross rental for that property and you minus all the operating expenses. Don't include any mortgage, don't include any sort of depreciation, anything like that. It's not included. This is just the gross rental minus the operating expense, and that should be your NOI. And that's really a good way for you to value the property and to value sort of, is this really something that I want to buy, or is this something that I want to kind of veer away from? Which brings me to my next one, which is just as important, and that's your capitalization rate. Capitalization rate can be easily calculated by taking your Again, taking that notice net operating income and dividing that by the sale price of the property to measure the performance without necessarily considering any finance with this. Again, it's really just a way for you to be able to see if there's a return on that investment that you're going to put in, considering it's all cash. What sort of return on investment are you going to get out of it? Now, cap rate, if you see a high cap rate, a lot of people are like, oh, it's a high cap rate, I should be getting a lot of return on investment. Not necessarily. Same goes with the low rate. Just because it's a low rate, it doesn't mean that you're getting a low return on investment. It's also not necessarily, because it depends on multiple things. And let me just kind of dive into it a little bit. Location plays a massive, massive factor on all of these. Commercial, we always talk about location, location, location when it comes to residential for your home, because you want to be close to schools and things like that. With commercial, it's even more. Like if I have to put location, location, location on steroids, that's essentially where commercial comes in. You can make or break that business. You can make or break that investment by having the wrong location. So how does that factor into something like the cap rate that we're just talking about? Location, for example, like if your property is in a bad part of town, or the age of the property is kind of on the up and up, or the property type itself and the type of clients that you're getting into the property in terms of rental is in a bad neighborhood, you're definitely going to have a higher cap rate. The reason being is because you have to compensate somehow. So what I mean by that is obviously your net operating income is going to be a little bit higher compared to the price of the property. And the reason being is because you want to compensate for the fact that you're taking on a risky sort of investment. In Ottawa, for example, like if I'm buying a multi-unit as an example, just to simplify things, and I want to buy that multi-unit somewhere in, let's say, Nepean, it's obviously going to have a very low cap rate between 4 and 6%, which is very decent. It's extremely good cap rate. You're making money, you're breaking even, and you're definitely going from there. But take that same property and you place it in somewhere out in the East End, let's say Vanier or around the Vanier area, and it automatically will jump up to 12, maybe 17% on a cap rate, which is really high. But the reason being is because obviously the property location is garbage. You're not getting the best sort of tenants, if you will, just because of, again, that neighborhood itself is like a lower income, possibly welfare, possibly it's just not the greatest quality of tenants that you're going to get in there. The same goes for commercial. It's also like if you have an office building that's centered downtown, or brand new building downtown, that's like AAA building, you're definitely looking at a very low cap rate. And for you as a very, very sort of new investor, it might not be the greatest opportunity for you. You're not going to get a ton of return on that investment because it is a low cap rate, but it's also because the building is still new. Yes, you might not require any sort of fixing and cleaning and doing all of that, but definitely it's not going to be giving you the return that you're looking for because there's no room for improvements. And that's something that we could talk about as well too. And where you want to spend your money is you want to spend your money on, sort of I don't want to say lowest class possible, but the lower the class, the better it is for you from an investment standpoint if you have the ability to do some improvements. So we'll talk about that a little bit.
Okay, so a part of what I'm hearing too is there are some similarities between, multifamily when we talk about cap rates and also commercial when we talk about cap rates. But I want to sort of highlight two things for people who are watching. So the first one is that although we might say, okay, this is the cap rate for Toronto or for Ottawa or for Calgary or for Vancouver, what I'm hearing is it's extremely neighborhood specific, and you need to make sure you know and understand the market in order to decide whether you're purchasing something at actually a good cap rate. Because the same as with multifamily, you could find something that has a higher cap rate and it looks like a better investment, but there's a trade-off in risk versus reward. So typically the higher cap rate can be an indicator that there is greater risk associated with it because the building is older, the tenant might not be as strong. There's a whole bunch of different factors there that kind of play in together. So commercial is not really a cut and dried so much as it's a understand your ability to withstand risk, your appetite for risk, and then finding the right neighborhood or location that provides the return you're looking for, and it's offset by the amount of risk that you're taking. Is that a good summary?
100%, 100%. And then the biggest thing too, like one thing that we always talk about when it comes to residential is always, if you're buying for example, a multi-unit or even just a one unit when it comes to residential is have at least a couple of months of rent available, right? With commercial, it's mind blowing because it's a lot more risky when it comes to stuff like that. You want to have at least a good 12 months worth of, keeping the lights on in lack of better terms, like being able to pay the mortgage and do all of that stuff,
Reserve.
the taxes, reserve fund. And the reason being is because just because the returns are higher and you're able to kind of rent it and get somebody solid for 5, 10, 15 years, whatever that sort of commercial lease that you decide to put it together, the time that it takes for you to find that particular tenant is significantly more because it's not just like here, for example, on the residential side, it's really just as simple as getting a couple of pieces of ID, see if they have their income, see if they have potentially a good credit. Fantastic, Bob is your uncle, and you check a couple of references and good to go. But on the commercial side, it's a complete opposite. You still need the person's credit if they're starting off a brand new business. You still want to kind of take a look at their financial statement if they, maybe moving in and they already have a business, or if they don't, well, maybe you want to look at their business plan. Does that business plan make sense? And this is where your team of lawyers and accountants that come in really handy because I don't know about you, but I have a financial background, so it's easy for me to kind of read business plans, but not everybody has that privilege, right? Like you might want to take it and send it to your accountant and say, hey, couple $100 here, please review this for me and tell me what you think. And that's when they're going to tell you, okay, this is sound. It looks like these people have already put a thought into it. They're going to be putting, they're going to be providing a good 6 month, 8 months worth of investment, and then they should be making money after 8 months. So you are taking a risk for sure, but your risk is even greater. And that had completely shifted as well too. So before the pandemic, we weren't doing that. If you wanted to get into a commercial property, let's say a retail of some sort, you have a heartbeat, great. You got a little bit of a pulse, no problem. They just want to know that you got good credit and somewhat of a pulse and you have a business idea and that's all. Nowadays, it's much more strict and it's really good for you as an investor because you really want to take your time. And that's why I'm saying, plan on having at least a good 12 months just in case, because it could take you up to 12 months. If you don't price it properly, it could be longer. If you do price it properly based on the current market and the square footage and all of that stuff, you're definitely going to be able to lease it out within a good 6 to 8 months and you're good to go with the right tenant for a long term.
The way I've always explained it to newer investors, when I've directed them to look more at residential over commercial, at least initially, is everybody needs somewhere to live, but not everybody needs somewhere to run a business. So your pool of potential people is typically much smaller, and the vacancies carry a lot more risk with them because they can be it can be a much greater period of time, as you said, before you find the suitable or the ideal tenant for your space.
Correct. So evicting is not really that big of a deal because if they don't pay the rent, you can evict them, you can close, switch the locks, do all of that stuff. It's getting them in is really the where you want to take your time and make sure that you have that sort of a runway in case. And when I say runway, I mean like how long does it take for you to run out of money before you have to sell the place? We never want ever to bring somebody into a property or have them become a landlord for a commercial property without having that good runway that they can go on. With that being said, another thing that a lot of banks look for is something called debt service coverage ratio. I'm glad that we kind of touched on that because this will make a lot more sense when you talk about that. And what that is, it's basically you're taking your net operating income that we've already calculated, and you divide that by the 12 months of payment and see if it's a factor of 1 or less. There is no way you're going to get cash from the bank to support this. If it's a factor of 1 and above, they're always going to look at about 1.2, 1.25. And this is where cash flow starts to become something important. If it's at 1.0, that's not a cash flow property. That's basically you're just about breaking even. So with your net operating income, you're paying down the debt and you have nothing to show for after. You really want to have at least between 1.2 to 1.25 or above if you can. That's fantastic. It's very hard to have above that, just because, again, like it becomes really, really competitive to be able to find a property with higher than 1.25 as far as the debt service coverage. But that's essentially what the bank is looking for, to see, is there enough cash flow coming into the business? And that's, as an investor, that's really where you want to be. You want to be in a property that's bringing between 1.2 and 1.25 in terms of cash flow. So you know that every month you have a solid amount of cash coming in, to run your day to day. It's not like that's your cash flow essentially.
So do you think the greater opportunity comes from buying a commercial piece of real estate and renting it out? Or do you think there's more opportunity from buying a business that comes with a piece of commercial real estate, or buying a business and then buying real estate to run it out of? Do you think that there's more opportunity when you kind of marry the ownership of the business and ownership of the property?
There is a massive differences. There's also a massive opportunity in all of these. Like, you can do one, you can do both, you can do all of the above. It really all depends on one thing, is your capacity, your ability to be able to get a loan, do all of that stuff. Let's talk about one thing first. For example, if you're buying a property to lease it out, there is still that sort of BRRRR mentality that we talk about with residential. And it's actually the same exact sort of situation, right? Like, you're buying, what you're doing at that point is you're renovating it, you're renting it out, you're refinancing, and it's the same exact thing. You would want to buy a property, but what you're looking for is a different class of asset than what you would normally look out for in residential. The difference is commercial is a little bit more defined when it comes to that. So, for example, every one of those assets that we've talked about, there's always an a B, and a C class. An A class is basically something that's brand new, very great neighborhood, fantastic in terms of the expenses are very low. It's prime. And those ones obviously have amazing neighborhoods and they rent out fast. That's not really your biggest sort of make or break, because these ones they tend to be very low margins in them. You're not going to make a lot of money. The rent is high. It's already at a high level, right? Like, they're coming in at the highest rent possible. But for example, if you pick something with a B class or a C class, this is where you're going to make the money really go further. So I'll give you an example. I pick up an office that has a little bit, an office building, for example, that has maybe 4 or 5 offices in it, or a strip plaza, and it has a few offices in it, and it's maybe in a B neighborhood. Okay. But it also old and it requires some work and some renovations. I might come in and, let's say I picked it up at $1.5 million, 2 million. I put another 200,000-300,000 into it in terms of reno. Now I'm able to re-rent it. And the beauty about it is you can always kick them out. The rent is done. Like, you want to cancel the rent, it's, you can negotiate canceling that rent with them. It's not the same as your residential. And it's also easy for you to kind of, cancel it and just say, hey, this is based on the fact that I'm doing massive renovations. They can come back and rent if they want at a higher rate. So that's when you buy it, you remodel it, and then you rent it at a higher rate. You're rehabbing it, and then you're going out and kind of putting it out to the market, and you refinance all over again. So you pull that equity and then go to the next one. So that's one way to do it. Again, commercial is still the same kind of methodology in a way. But there is that option for you to be able to do something like that, where you buy, rehab, rent, refinance, and then repeat.
What kind of down payments are you looking at for commercial space? And then what are you seeing on the refi? Is it 30% down to buy and you're leaving 30% in at the end? Because that's one of the things the BRRRR strategy has been challenging, at least in Ontario for the last couple of years, because the refi numbers aren't making a lot of sense on residential properties.
Correct. On commercial is a little bit different. Commercial mostly, I want to say like 75, 85% will require you to have a 25% down at least. Now, well, we're going to talk about something a little bit different here. Unless you're buying it and you're actually going to operate the business out of it, it's a little bit different. That's something that, organizations like BDC, for example, would have a special take into it, lower down payment. They can even go up to 100% financing on it. It just depends on the business. For anybody that has questions on those, hit me up. I can always explain to you what is it exactly. It's like nuances. It's not with every single business that they do this, but it's definitely available. But if you're buying it in the terms of like, I want to invest in this, I'm not going to be owner occupied. You're definitely looking between 25 and 30, 35%, depending on the asset class and depending on which part of the city. It also depends on the lender as well, too. So it's not the same as residential. We can get away with 10, 15, 20%, or even just 20% when you're doing sort of refinance or investment. You will need at least 25% here. So it definitely is dependent on the asset class and depending on the area and depending on the mortgage lender as well.
Gotcha. That's helpful. Thank you. Just so that when people are running numbers, they kind of have an idea of what they need to come in with. So it sounds
Mhm.
like if we were going to buy something, you sort of talked about the starter 500, 600,000. If we anticipate 25% of that, we need to be coming in with some capital of our own.
Correct. And then especially like those ones are probably like if you're looking at office space or retail as well too, which you can still buy a retail unit depending on how they organize it. Those are always set up as a condo, right? It's a condominium that's taking care of it, and all of the condo fees are actually, including all the operating costs. They're all within the condo fees. So it's easy for you to go and say, okay, I'm going to buy an office at 400,000. It's going to cost me, 20%. I'll put 100,000 down or 25%. Let's say I put on 125K down, and then you go out and lease it, and you're still able to cover the rent. You're still able to, cover the mortgage, and have a little bit sort of cash flow as well too, based on that. So the numbers will have to make sense. Those ones normally are around, I want to say 4 to 6% as far as the cap rate. They're still
Mhm.
going to be great for you. They're still going to, get you what you're looking for in terms of investment. The biggest, if I go back a little bit in terms of the BRRRR methodology, the biggest thing when it comes to the BRRRR methodology is you want to look at buildings that have lots of demands. Those are the Class C buildings, right? And the reason being is there's a lot of building that get, coming into the Class C buildings, right? It's been around for 20, 25 years. All of a sudden now it requires maybe a facelift, maybe it requires a full sort of gut, whatever. That's going to become a little bit more into the Class C buildings, which means you're going to get the highest return on investment if you have that capital for you guys to go and refinance or fix it and then refinance it and then go from there. And this is where looking at, for example, joining ventures with multiple other investors, or looking at raising capital with a bunch of investors to be able to get into a project like that, it becomes really handy to have a network of people that could actually help you with that as well.
Yeah, I agree with that. I think part of the reason we've seen so many investors stumble and fall is because so much has been sold. And I'm not disagreeing with you because partnerships and OPM, they have been part of my journey as well. I think what we've seen in the last couple of years is this over leverage where people are thinking that they can buy real estate with none of their own money, not contributing anything but knowledge. And I think the reality is whether it's commercial or residential, that's a very risky position to hold, and it's not your money at risk, it's other people's money. So I think that it's prudent at this point to sort of caution people that you can absolutely use partnerships and you can absolutely use OPM. You need to be really strategic and you need to be really cognizant of it, because the likelihood that you will borrow someone's money, lose it, and come back again as an investor is typically very low. So you want to
Yeah,
make sure that you are making good decisions and stewarding other people's money well and with a good conscience. And that may mean that you start smaller. So you're not looking at buying, the office building. You might be buying a smaller strip plaza to start, to build your capital, to build your equity, and then to be able to refinance that and roll it over into a bigger building. I think there's been a lot of hype about growing really fast, getting really big, and we have abandoned the basic concept of making sure that our investments are high quality and we're not over leveraged. Is that okay to throw
for
that
sure, for
disclaimer in
sure.
there?
No, absolutely. And I think to add to that as well, too, Elizabeth, I would highly recommend when you're setting something up like that, involve your lawyer from the get-go. This is where you don't want to be leaving this with your shirt off your back. You know what I
Yep.
mean? The whole idea is for us to get into it and be secure. And especially if you're getting other people's money in there, you want to make sure to be fair for everybody. And that's where a lawyer comes in very handy.
Yeah. And I agree with you. And I would also encourage you to have a coach or a mentor or somebody who has been there and done this before. Your lawyer should be providing you advice on what is legal and how to protect yourself and how to mitigate liability. Sometimes, depending on the lawyer, they like to kind of cross the line and start providing you with business advice. I don't typically like to take my business advice from my lawyer because most of them, other than operating their own practices, they don't really invest in business. So I always want to choose people as my mentor, as my coach, who are doing what I want to do successfully already, so that they can share their experiences and their ideas, which is why I would come to someone like you, Fady, for example, if I wanted to learn more about, investing in a commercial business, because you do these things.
No, absolutely. And then we have a saying back home. It says, give your bread to the bread maker, even if they take half of it. Because, at the end of the day, that other half that you're going to keep is definitely going to be nice and, great, that you're going to eat it and it's going to be delicious. More so, like I would really want to kind of harp on that point there with hiring a coach. Really important that you see that there's this concept of you see one, you do one, and then you do many. But before
Mhm.
you see one and do one, it's very hard for you to do many. It's almost impossible. And you will fumble and you will fall. But when you see one, maybe join venture with somebody and let them show you the ropes. Then you do one, have them kind of oversee the process, even if they take half of it. And I've done this with my first couple of transactions as well, too, as a realtor. I've had a mentor, give them half of my transactions because I wanted to learn. I wanted to do this properly, the right way. And then you do many. And then when you do many, you still also have a coach at the end of the day. It's very, very important to have a coach because then, you could end up losing a ton of money. You could end up losing your whole life investment when it comes to that.
Yeah. And
I don't
unfortunately,
know
there's a
if we
lot
have a
of
lot
people.
of time left, but we want to talk about, sometimes for folks that are trying to start a business, what's the best way to do it, Kelly?
Well, it depends. I mean, it sounds like, and I appreciate you saying that, because if you have capital, then I think buying businesses are absolutely the way to go. If you are in a situation right now where you're looking to create cash flow and you either don't have the opportunity to be able to dedicate full time to a business, or you don't have the capital to purchase a business, right now, my favorite way to go is to start your own business. And there are a
Hmm.
ton of different low capital, low investment businesses that you can start that are in demand right now. And honestly, one of the best ones I've seen is cleaning. I don't know. Are you seeing a lot of cleaning companies?
Oh yeah, I have a ton of cleaning companies that I work with regularly, especially when it comes to listings, right? Like we hire them all the time to clean, and when you ask them how they started, it's one of the lowest barrier to entry businesses out there because all it is just I have a car and I've got a bucket and a mop and
And I got a good work
possibly
ethic.
a vacuum and great
Yeah.
work ethics, and I show up on time. And
Yeah.
that's the biggest one is showing up on time. Like I could count on multiple hands the amount of cleaners that I had to fire because they don't show up on time, or they leave the place with something left in there, or something. Work ethics is massively important. There is always a good way to look at it. Like when you're starting a business, you could there's multiple ways. You could either start the business or you can buy the business, like you said. And this is one of the one of the main things that we do in our first initial consultation when someone is sitting down and they're like, "Hey, I'm thinking of starting this type of business," is to really explain to them the differences between the two. For
Mm-hmm.
example, like if I want to start a business like cleaning service or whatever, it depends on what is it that you need. Like for, if you're looking at starting a business that requires you to have a retail shop, well, you definitely like the startup is going to be a little bit more than just a bucket and a mop. You would
Mm-hmm.
definitely need at least a location. So this is where things like setting up with an accountant and building a business plan really comes handy. Because me as a landlord would want to take a look and see you've thought about all of this, you've thought about marketing, you've thought about sales, you know what you're going to do, you know what your overhead is going to look like, you know what your rent is going to look like because you budgeted for it in there. I want to know that I'm going to get paid. So
Mm-hmm.
that's a big portion of it. And we always say, even if you're great at writing business plans, have an accountant just take a glance at it at the end. If you have it fully ready, just have them take a quick little look and say, okay, yeah, this is fantastic. I'm going to go forward with this. That's going to make or break you getting the lease or not. Because in some situations, like we take a look, they have great credit, good working history and all of that, but which they look at, by the way, you've been working somewhere because they want to see your work ethics. But then when it comes down to, having some money aside as well too, because let's just say I'm starting a meat shop, for example, right? I still want to see that they've thought about everything in terms of advertising, marketing, all of that, overhead, amount of employees, all of that. But I also want to see a little bit of cash in the bank, right? Because when it
Mm-hmm.
comes to leasing, there's multiple deliverables that we have. We can deliver it bare bone, we can deliver it ready to go. We call it vanilla. We can deliver it whichever. We want to make sure that me as that the tenant coming in, if I'm coming in, how much outlay of cash do I want to put in to fix the place the way I want it to be? I might have to put a hood oven. I might have to do something different to make sure that this fits you know, my area of expertise. Or you can buy a business, and that's another option. But buying a business is really, it's a process, right? Like it's not, even selling a business, it's the same kind of process, but it's reciprocal. When you're buying a business, it's a lot more that goes into it because then you're talking about a full cash flow. Like I'm buying a running business, so I don't have to worry about advertising as much because I know it's already there. I just have to kind of keep that wheel going. Because of that, it's a higher cost. It's going to cost me a lot more to be able to get something like that. So that subject, and I know we don't have a lot of time, but that like those two things can take us probably 3 hours to discuss between whether do I want to start up a business or do I want to actually buy one. But just to make it very, very simple and very easy, when you're buying a business, it's a lot more outlay of cash. You can still finance it. Some businesses can be financed. You still need a bit of a down payment as well. And depending on which kind of organization you go with, that down payment varies. For example, someone like BDC can actually end up, and I'm not making any sort of advertising for BDC, but I work quite significantly with them. Depending on your age, there's a lot of programs that can give you up to 80-90% when you're purchasing a business as well too. So that's something that could work in your advantage. So there's pluses and minuses, but I'm also buying that business with all of their pluses, like their customer base, their
Yeah.
location,
The
their all of that
reputation.
stuff, presentation, marketing, everything that they built, and the goodwill that I buy that with it. Or I also buy their problems. If I'm buying the actual business, I'm also buying their debt. And it depends on if I'm buying shares or I'm buying the corporation. There's so many different ways to do it. I'm still buying it with all of their debts, their problems, their bad experience that they had with customers. All of that stuff is still something that I'm having to pay for, and I'm having to watch out for. So it really all depends on if you want to start clean or do you want to just have something that's already going and then continue with it. It depends
Yeah.
on you, your appetite, you know, are you risk adverse? Are you not risk adverse? All of that stuff matters, and that's why we're here.
Yeah. Yeah, absolutely. So let's just kind of round out in the last couple of minutes. We don't have any questions. I think you kind of blew everybody's socks off. So Either that or everybody's just furiously taking notes. If you have any questions, throw them in the chat box right now, and because we do have a couple minutes. But where do you see the biggest opportunity right now? Like if you had $100,000 or $150,000, what would you do with it right now in these sort of commercial spaces?
That will probably get me a lot. When I say a lot, like a lot, a plot of land, I would
Mhm.
probably do something like a plot of land just a little outside of the city, and look at renting it or leasing it out for someone that's willing to put the work in for industrial. And the reason why is because it's one of the hottest items right now, where everybody's looking at sort of a warehouse situation that's closer to the highway or closer to, means of transportation. That is where I would start. Or you can start with an office. Both of those investments are different. Both of them are, actually industrial seems to be a little bit, higher return just because of the, again, the lower barrier to entry. But both of them are just as good investments to start with. I wouldn't go and try to, buy a business if I don't have that sort of knack for business. I would like to each their own. And then this is the thing with commercial. It's if you think residential is, 1 to 2, 3 units and it's not for everybody, commercial is completely not for everybody because it really takes a special skill, a special person, a proper evaluation on everything up front before you start. And more important, that you have to kind of line yourself up with the right asset class or the right type of commercial asset that could work for you and your personality and your appetite and your risk factors.
Yeah. Yeah, those are great points. Melanie is asking about thoughts on VTBs in commercial space. I think there's a lot of kind of misinformation out there about VTBs. I think people, the idea, the prevailing thought, and Melanie, correct me if you if this is not what your thoughts are, but I think a lot of people assume that a VTB is kind of like how you circumvent the banks if you can't qualify. And from what I've seen, especially in the commercial space, you still have to qualify for VTBs. So it might be that instead of dealing with a bank, you're dealing directly with the seller. That's what we're talking about. A VTB, for anyone else who doesn't know, is seller financing, or basically the seller holds the mortgage. But in my experience, even the sellers now are being much more picky about who they are leaving their money with and who they are lending money to. Are you seeing that as well?
Yes, a VTB is very, very tricky to even get approved. And even if you do get it approved, it's really more of a second mortgage, right? Like so you have your lump sum of down payment, and then you go and do the evaluation with the bank, and the bank says, okay, I'm gonna give you, let's just say $1 million. The property is worth $1 million, you're able to put 200,000, that's your 20%, fantastic. But the bank is only supposedly giving you, let's just say as an example here, another 600,000. So you're about 200K short. You can go back to the seller and say, hey, are you willing to offer VTB? Now, when you're asking for things like that, your hand is behind your back. Good luck trying to get a deal from the seller, because the seller obviously wants to sell, yes, but now you're asking for extra stuff. So to get a good price, you want to avoid VTBs. You want to avoid anything that would take that sort of place of power, if you will, and put it or place it with the seller. Now, there's also the ones that are completely VTB, like the whole thing is VTB, where you're putting maybe 10%, 20% down yourself, and then you're mortgaging it directly from the seller. That's a little bit less, you know, we see that more common actually than the other ones where the bank is taking care of it and then you're going back to the end of it for the seller. I don't recommend them, but they do work, and it just depends on your situation. It's to each their own when it comes to kind of putting it out. I do recommend you doing a ton of work in terms of the numbers and see if they make sense. A lot of the times they tend to be less advantageous for you.
Hmm. It's like the CMHC MLI Select for residential. Just because you can do it doesn't mean that you should do it, because sometimes the numbers get really wonky when you have high loan to values.
Correct. Correct. Just because something is allowed, it doesn't mean that it's the right investment or the right thing to do for you and for your investment.
Yeah.
That's why you hire us. That's why you hire lawyers. That's why you hire accountants, is to do all of that stuff for you. And I'd like to invite everyone here, if you're in and around the Ottawa area, shoot me a message. I'm always open for possibly a coffee or sit down and talk. The first hour is free. After that, I charge. But anyways, it's just basically like I'd love to kind of just share my knowledge with a lot of people out there. And you know, at the end of the day, one of the things that I really made me get into real estate is I wanted to make sure that it's done differently. It's done with a little bit more ethics and a lot more, you know, tenacity, and a lot more sort of making sure that everybody's on the same page when it comes to being authentic and being completely above board.
Perfect. I love that. I love the integrity piece of it. We do have two questions in the Q&A. We have run out of time, but so Prav has asked, how will the looming tariffs affect commercial? And Daryl said, what about trailer courts? So I think what we'll do, Fady, is to have you, you know, sort of share your thoughts on those, and then we'll send the answers to those questions out with the recording that'll go out before Friday. If that is okay for you, that's how we'll get those questions answered. Let me just do a quick screen share here. All right, so thank you so much for those of you who joined us today live, and for those of you who are watching the recording afterwards. Here is how you can contact us if you want to talk more about commercial, if you want to talk more about opportunities and investigate you know, whether this is the right class for you or the right investment move for you, starting a business, buying a business, investing in commercial, pros and cons, tons of research to do. It's a whole new world out there. And one of the things I love the most about commercial is that you just have so much more control. So if that is something that you are looking for, this absolutely might be the right solution for you. Fady, thank you so much for your time, for your knowledge. We are so grateful for both of those. And I hope everyone has a fantastic week. Do you have any thoughts to wrap up, Fady?
No, I really appreciate it. Thank you so much, and appreciate everyone joining us. And anyone that, like I said, they have a question, they have my contacts here. Feel free to reach out. If I don't get back to you within 24 hours, something is off. So feel free. Instagram is probably the fastest way that I can get a hold of anyone in. And yeah, if you have any questions, don't hesitate. I'm always here.
Fantastic. Have a great week, everybody. Stay safe and healthy, and we'll see you again in March. And that announcement, my March webinar announcement, will be coming out in the next week or so. Take care, everyone.
Bye,
Bye-bye.
everyone.